Welcome to this explainer. Today, we're doing something a little bit different. We are totally stripping away human emotion to look at the cold, hard mathematical truth behind our massive life decisions. You see, as humans, we're incredibly prone to making choices based on how things feel, or our egos, or just pure societal pressure, rather than how the numbers actually add up. But today, we're going to put those feelings aside, ignore our gut instincts for a few minutes, and just let the spreadsheets do the talking.
So, here is our roadmap for the breakdown. 1. The day trading trap. 2. Renting versus buying reality. 3. The math of innovation. And finally, 4. Time, discipline, and wealth. We're going to connect the unifying math of stock trading, real estate, and literally rocket science.
All right, let's jump right into part 1, the day trading trap, or mistaking activity for progress. Okay, let's dive into this. Picture three 30-year-old guys. They all make the exact same salary, and they're all putting $1,000 a month into the stock market. First up, we've got Tyler. He's the frantic, active trader permanently glued to his multi-monitor setup, hunting for daily trends. Then we have Greg, the slightly calmer trend follower who rides momentum for a few weeks at a time. And finally, there's Ryan. Ryan is the incredibly boring passive investor who simply buys an S&P 500 index fund every single month and completely ignores his brokerage app. Now, for the first few years, Tyler feels like an absolute genius posting screenshots of his big wins online. But he is entirely ignoring the hidden financial leaks that are quietly destroying his wealth. First, there's the ordinary income tax wrecking ball. Because he holds stocks for less than a year, up to 22% of his gains go straight to the IRS. Second, the silent friction. Things like bid-ask spreads and hidden trading fees just evaporate roughly 2% of his money annually just for participating. And lastly, well, pure ego and overconfidence lead him to constantly sell his winning stocks way too early. So let's watch how this exact math plays out across a 30-year timeline. For the first 5 years, Tyler and Ryan look pretty neck and neck. Tyler might even be slightly ahead. But as time goes on, the sheer force of compound interest violently separates Ryan's relentless, boring strategy from Tyler's incredibly volatile chart. By year 15, Ryan drastically pulls ahead. And by year 30, that is when compounding does its most brutal work. After 30 years of each investing that exact same $1,000 a month, here is the shocking financial outcome. Ryan, the guy who did absolutely nothing but consistently buy his index fund and actually go enjoy his life, he ends up with nearly $1.8 million. Tyler, who treated the market like a stressful full-time job, lands at roughly $511,000. But wait, here is the absolute gut punch. Tyler didn't just miss out on over $1 million of potential wealth. Over those 30 years, he spent an estimated 60,000 hours staring at screens, reading charts, and stressing out. He literally worked an entire second, completely unpaid career for the profound privilege of drastically underperforming the guy who spent maybe 3 total weeks of his life glancing at an app. Moving right along to Section 2, renting versus buying reality and the true cost of housing. We've all heard this classic piece of advice, right? From parents, friends, everyone. They say renting is just throwing money away, while buying a house is the ultimate guaranteed path to building wealth. The societal pressure to buy is just immense. But let's actually look at the cold, unemotional numbers behind that feeling. Meet Jake and Marcus. They're both 32 years old, and they've both saved up $70,000 in the bank. Jake follows the traditional path. He buys a $350,000 home using his $70K as a 20% down payment. Marcus, on the other hand, decides to rent a nearly identical home. But Marcus is mathematically disciplined. He takes his $70,000 plus the $653 a month he saves by renting instead of paying a mortgage, and he diligently invests every penny of it right into the market. And this brilliantly illustrates the mathematical reality of homeownership. In year 1, Jake's total monthly housing payment is $2,653. But if you break down where that money actually goes, it's wild. A massive $1,633 goes straight to the bank as interest. Taxes, insurance, and maintenance eat up almost all the rest. Only $230 actually goes toward building equity. Jake is essentially throwing away over $2,400 a month on unrecoverable costs, while Marcus is only throwing away $2,000 on rent. The real test here is what happens over a decade. By year 10, Jake has built between $237,000 and $254,000 in home equity. But Marcus, the renter, because he let his initial $70K down payment and his monthly rent savings compound in the market, his liquid portfolio has grown to an estimated $291,000. The math completely proves that a highly disciplined renter can actually outpace a homeowner in net worth. Now, does this mean renting is always better? No, absolutely not. Here are the exact mathematical conditions. Buying definitely wins out if you stay put for 7 to 10 plus years. It acts as a forced savings mechanism, and your housing costs eventually fix themselves against inflation. Renting, however, is the mathematically optimal strategy if you plan to move in 3 to 5 years, allowing you to avoid huge transaction costs. But, and this is a massive but, that only works if you have the perfect discipline to actually invest the difference.
All right, let's pivot to section 3, the math of innovation, scaling physics to global problems. So how does an innovator take this kind of rigorous, unemotional math and apply it to global human challenges? How do you dismantle assumptions that the rest of the world considers entirely impossible? Well, let's look at Elon Musk in his early days, way before the massive fame, to see how he applied this exact same numerical logic. In an interview from 2007, Musk explained his foundational logic, which he actually came up with during his college days. Instead of just chasing whatever trend was hot, he identified 3 pivotal, mathematically viable areas crucial for humanity's future: the internet, multiplanetary space exploration, and a solar electric economy. He picked these based purely on the raw physics of what was necessary for survival, and what the math said was actually possible to build.
Now, what's really interesting here is how this highlights the monumental, true scale of difficulty for SpaceX compared to what others were doing at the time. When asked about competitors like Virgin Galactic, Musk broke the problem down purely by physics. Suborbital flight goes about Mach 3 and requires 9 units of energy. SpaceX's orbital flight, however, has to hit Mach 25 and requires 625 units of energy. By focusing strictly on raw energy requirements rather than just appearances, he proved his company was solving a problem on a completely different technological scale. And he applied that exact same structural math to the auto industry with Tesla. He knew the math simply didn't support building a cheap electric car on day one. So he walked through a logical equation. Step 1, enter the market with a low-volume, high-margin sports car to fund the research. Step 2, use that money to build a mid-tier $49,000 sedan. And Step 3, scale up production enough to finally afford making a $30,000 mass-market vehicle. It was a perfectly calculated step-by-step timeline to drive new technology into reality. Which brings us to our final synthesis. Section 4, time, discipline, and wealth. The unifying truth. The absolute core realization of this explainer is this: the ultimate trap is mistaking activity for progress. Think about it. In finance, trading 100 times a day doesn't make you richer. It usually makes you poorer. In housing, paying a massive mortgage every month doesn't instantly mean you're building equity. A lot of times you're just paying the bank. And in tech, building something that just looks like a spaceship doesn't mean it has the mathematical energy units to actually reach orbit. Motion does not automatically equal forward momentum. The cold, hard math of reality dictates this truth: the market doesn't pay you for effort. It pays you for patience. Whether it's Ryan letting his index fund sit completely untouched for 30 years, or Jake patiently holding on to a 30-year fixed mortgage to beat inflation, or Musk mapping out a multi-decade timeline to reach Mars, the math inherently rewards patient, calculated discipline over frantic, emotional action. So I'm going to leave you with this final provocative thought. Audit your own life. Are you making your biggest choices based on the math or the feeling? And more importantly, in your frantic pursuit of progress, are you secretly paying hidden costs for the profound privilege of losing your single most valuable asset, your time? Take a look at the math in your own life, and I'll catch you in the next explainer.